All right, let's do this one. This is going to be a fun one. This has been a big deal over the last 2 years for all these landlords out there, everyone wanting to be a landlord. Really nobody talks about this a lot, so let's give it a whirl and see if we can help some people figure this out. So folks can buy a home as an investment property and not have to show their income, period.
Correct. Yep. It's simply based on the cash flow of the property. And if the property is going to cash flow and you have the amount of funds and an acceptable credit score, you're in. So it's been really big for people that maybe are self-employed and have a ton of documentation that would be required. So there's a convenience factor. Or if the tax returns, maybe they take advantage of some write-offs and don't show the taxable income, another great alternative.
All right, so you don't need a job, like literally. We don't put any job information on the mortgage application.
Correct.
Okay, so the cash flow of the property is based on market value of rent?
Yes. So that comes from the appraisal aspect of that, where there's an added section to a normal appraisal that is an operating and income statement, or I'm sorry, a comparable rent schedule, where the appraiser goes out and says, hey, this similar property in this marketplace typically leases out for X amount. And then that's the revenue or the income that's used for the loan file and the qualifications. Super simple.
All right, so let's say it's $2,000.
I got my calculator ready. Fire away.
Okay, so $2,000 a month, you're collecting rent on this property. And how do they calculate what your max PITI can be off that 2,000?
So general rough sketch is 2,000. We take 3/4 of that, which would be 1,500. And the payment for the new home, including taxes, insurance, and any HOA dues, cannot exceed that 1,500.
Okay, so we're backing into a maximum loan amount, and then there is an LTV requirement. They're looking for how much down on these properties using this program.
Generally speaking, it's 20% down. There are
Okay.
some exceptions where you could go as low as 15. But if you're a first-time investor, it's 20% down. Those guidelines continue to change a little bit in this landscape, but if you assume 20% down, that's safe.
All right, so the interest rate is substantially higher. Where's it
Ballpark
at
is,
right now?
right now on conforming interest rates, we're hovering around 6.25% on a primary residence purchase, with 20% down on one of these, what's called DSCR loans. You're looking at rates that are going to be around 8.25% to 8.5%.
Okay, so this is a long-term play that you believe you're going to hold on to this property, and you're going to factor in appreciation over a period of time, as well as paying down the balance of the loan where the money's coming from the renter.
Absolutely.
So in theory, that 2.5% interest rate spread isn't going to bother you that much.
Yeah, I would say it's similar to when we talk to people and they sort of get irritated about PMI, right? Meaning that, yes, the interest rate, if you don't have to pay it, don't. But in these scenarios, there is obviously an income opportunity and a rate of return and a long-term play that is going to make people money. And they don't have the ability to take advantage of either paying cash or traditional financing, so that 2% premium in interest rate, you can look at that and go, oh man, that's really terrible. Or you can look at it and say, this gives me an opportunity to build long-term wealth, and I'll just look to adjust that over time if I can. So, we talk to people about that when, you're putting 5% down on a $400,000 home, right? And they go, I don't want to pay PMI. And I said, well, I think you're looking at that backwards, to pay $75 a month, but that allows you to hang on to $60,000 or get in without that $60,000 cash out of pocket. I view that more as a glass half full than a glass half empty. But again, we're getting back to the point of, if you haven't identified that that's going to build long-term wealth, then you shouldn't be buying it.
So you had talked about the self-employed folks that don't necessarily show all of their income on paper. Those folks that could do it that fashion, they're not going to get 6 or 6.25, but they're not going to get 8.5. They're going to get,
Right.
we'll call it
Probably
split the difference.
Yeah, say 7, 7.25, somewhere in that range.
So the convenience factor of not having to dig up all of that stuff is huge, right?
It's through the roof. Yes.
Okay. If we look back at 2021, 2020, 2021, we had saw something like 25 to 30% of the transactions being done in the last 2 years were for investors.
Yes.
So
I saw something, a recent stat out here, call it in Arizona. It was 1 out of 5 transactions. So that was 20% more recently.
So people were losing out, first-time homers, first-time buyers, and move-uppers were losing out to people who were using this type of financing in some cases.
Yeah. Yeah, because they have a decent sized down payment, right?
Yeah.
That these loans, investment properties require a larger cash outlay. So, from the seller side, that larger down payment was incredibly appealing for the last 2 years.
And to be honest with you, it still is, especially now with people not bidding them up over asking price. If you're putting 20-25% down versus 3.5 to 5%, that seller's going to.
It certainly commands some attention, right? If you're comparing one versus the other, it's worthy.
Yeah. Wild, right? What a wild ride. From the investor standpoint, they have some skin in the game. You've given them equity. You're paying a higher interest rate, higher than market interest rate. So they're doing okay there. So where is the risk in being a landlord? Let's swing back around, and I want to be a landlord. What should I be thinking? What are the cons of being a landlord?
I think the cons of being a landlord is just experience. So if you're a first timer, just making sure that your forecasts are factoring in renter turnover and possibly some maintenance associated with that home, either during the lease or when it turns over and you have some cleaning expenses. Speaking from experience, just going through this recently myself, finding a good property manager can mitigate a ton of the effort that's required. Meaning that I was amazed at how simple it was to have them get a tenant, help get the property spruced up, cleaned up, get it ready for showings.
Okay.
So that there's companies that specialize in that and can take a lot of the unknowns sort of off your plate, meaning that the manual labor or the legalities and the marketing of the property. What you don't know, though,
which is scary if you haven't done it before.
Yes.
Or you're like you use the word experience, not even necessarily being an experienced investor, but an experienced homeowner.
Yes.
Okay.
Fair. Yep. It's all that same normal stuff of being a homeowner. I mean, you're down there in Florida. We're out here in AZ. So, the immediate thing that you're waiting for is the wonderful call that says the AC is not working, right? I mean, that's really the kind of stuff that, you have to be prepared for, not to facilitate the contractor and getting the work done, but just from the expense side and building that into your model to say, all right, am I forecasting that my rate of return or my true investment opportunity here is valid or worthy?
And then you have the unknowns of what the market conditions will be surrounding the property that you end up purchasing, yada, 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 yada. Okay. So
Right.
super cool product. Very, very niche. Not a lot of people are going to go down this route, but we get
It is a
questions
small
on it.
section. Yes. It's something that's a great conversation piece, especially for our realtor partners out there when they're talking to, because everybody has fascination of what's going on in the real estate world right now. And what about investment opportunities? And, you get the question,
Yeah.
hey, can I snatch up a foreclosure?
Well,
all
when
those
it's
crazy
running
conversations.
40% over the last 2 years, you're going to get a lot of questions on it.
Yes. Yep.
So
the only thing that's been a little bit of chaos from our side is just because these programs are not through Fannie Mae and Freddie Mac, we've had 2 or 3 lenders in the last month that have gone out of business that were specializing in these loans. So the challenge is just your loans don't go through Fannie Mae and Freddie Mac, which are super stable. So the guidelines and the process can change
much quicker.
Well, yes, without any advance notice.
Correct.
So that's the only part of this that provides some maybe frustration from a lender side of it's not as normal as the conventional or conforming loan products. There's a little more fluidity in there.
I love what you say about the agents too. We have a lot of questions from the real estate agents that want to know about this product, at least to help educate themselves, whether they're going to do it or talk to other potential prospects that they're speaking with about it. So anybody that has any questions, please reach out. We'll walk you through the numbers. Please like, subscribe. Thanks for all the following. And Ken, have a wonderful weekend.
All right, bud. Take care.
See ya.